My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is Mr. Dan Niles. I'm sure a lot of you have seen Dan over the years and read his work. Dan, introduce yourself to the audience. Who are you? How'd you get involved in markets? And what are you doing with your fund?
Sure. So my career is probably a little less traditional. I started investing back in college, but got a master's degree in electrical engineering, did investment banking for 4 years, then was a sell-side analyst for 10, which means I was giving recommendations on Wall Street of what stocks to buy and sell to big institutions. And then I've been running a hedge fund for the last 19 years. So that's kind of my quick background. And my hedge fund, the big focus is really on good risk-adjusted returns over time. So in plain English, what that means is, the goal is to sort of have good performance, especially when the market is getting crushed. And that's what we're particularly good at, and trying to just build wealth over time versus, being up 100% one year and down 50% the next kind of thing. So that's kind of the short version, and we kind of focus on technology. That's kind of our specialty, just, given my background in tech.
Is the cynicism on sell-side analysts justified? And I say that purely from the perspective of you've had a lot of bank downgrades after the crisis started unfolding. Right. So talk about that, because I think it's always interesting, right? I mean, I get it from both sides of the industry. I'm a portfolio manager myself, like you. There's always an element of CYA when it comes to sell side, but I do wonder if a lot of this is, as a field, as a profession, sort of really valid for people to focus their own attention on.
I think you bring up a great point, because you got to think about it from what's your motivation. So if you are a sell side analyst, it's a hard job to get, but once you get it, it's really easy to keep. And what I mean by that is, so you got to remember, I was II ranked number one for a couple of years in my space, semiconductors, and also top ranked in computer hardware. But if you think about the job, if you are bullish, then the institutions like the Fidelities of the world think you're, smart, because you are obviously, somebody owns the stock, right? Regardless of where it is, even if it's a bank stock, somebody has to own it by definition. So those people that own it think, oh boy, you're smart, and you see this long-term value. And then of course the companies, if you're bullish, they think you're really smart as well, because, what company management have you ever heard that says, oh, my stock is terrible and you shouldn't own it? So the only way to really get fired is if you're negative and the stock goes up. And don't forget the institution where you work at. If you work at a big investment banking firm, the bankers hate you as well if you're negative, because they're trying to win banking business from these big companies. And so that's why in general, if you see ratings and price targets, et cetera, from sell side research, what I actually really focus on, if a guy has a buy rating on a stock, but you read the research and he's sounding a little wishy-washy, then you've got a problem. Because if he's got a buy rating and then he's getting negative, that's a really big issue, because it takes a lot to move guys to it. So the cynicism around sell-side research, I think, is completely warranted. And unfortunately, because you've been in this raging bull market since the global financial crisis, and every time the market goes down, the Fed pumps in more stimulus and the government gives you more stimulus checks. The only people that have really survived have been the ones that have been bullish all the time, for the most part. Obviously, if you are really good at your job and you can downgrade and get that right, you are in such a small minority, because you're taking such career risks, that you can, do very, very well. And quite honestly, that's how I made my career, because I downgraded pretty much everything I covered in 2000, thought there'd be a recession. Obviously, that turned out to be a pretty decent call. And that's kind of how, I got a good rep, because it was a career limiting move, obviously, if I got that wrong. But, fortunately, that turned out okay.
I love that point. It's like you hear about survivorship bias when it comes to stocks, not necessarily in terms of sell-side analysts.
Yeah, it's the same thing.
It's an interesting way to frame it.
Yeah,
it's the exact same thing. But take us back to that. I'm curious to just talk about just that time in your career. We'll get into the current markets and everything, but this is more just interesting for me. As you were downgrading tech stocks in 2000, I mean, were you getting pushback? I mean, what was sort of the client pushback and even the employer pushback at that point?
Oh, it was huge. So you have to remember, I started at Lehman Brothers, which is kind of funny given where things are today. I started Lehman Brothers in March of 2000. And for those of you who can remember, that was literally the peak of the tech bubble. And so, later that year, I still remember it because I was traveling and it was in Europe, and I saw these gas lines, and oil had really spiked, and there were trucker strikes in Germany. And I came back, and I'm a big believer in macro analysis to augment kind of talking to companies, and when all of that lines up, you can really get aggressive. And so I was like, this is going to be a bad recession, I think. And if that's the case, these stocks are trading at ridiculous multiples. So I literally downgraded both computer hardware and semiconductor coverage, and I got my juniors that were working underneath me to do the same with their stocks. The next thing that happens is the bankers are just incredibly mad at me. So they're calling up the director of research and saying, we got to get this guy fired. We're going to have no banking business. I'm getting a call on the phone. And I still remember this. And they were going, we're never going to be able to bank any of these companies. You downgraded everything. And I'm like, if I'm right, there's going to be no banking business to be had because these stocks are going to go straight down. And to his credit, my research director at the time, he was fully supportive. And he was like, look, we hired you because we think you're really good at what you do. And he was very supportive, but yeah. And then we got cut off by clients. And what that means is, so how you get paid, one of the ways firm gets paid is, let's say I'm recommending Intel or something, then a Janus or Fidelity, they will trade that stock through Lehman Brothers, and then you'll get some commission on that stock. And that's how you pay for research through those dollars. And so we actually got cut off for a period of time. I still remember some from very big institutions that said, your guy is terrible and he's awful and we're not going to trade with you, to basically try to punish the firm. And what I actually enjoyed was, I remember a few of those portfolio managers got fired because their performance was so bad during that 2000 period, because obviously it wasn't a good period of time. 2000, 2001, 2002, the S&P was actually down for 3 years in a row. So yeah, the pressure is immense for being negative, which is why I know the short sellers, quote unquote, get vilified all the time, but quite honestly, to be negative on a stock, you have to do so much more research, be so much more thorough than if you're bullish, because the amount of hatred you get is incredible. And the companies don't like you, the government goes after you. And quite honestly, a lot of those short sellers are the ones that figured out that there were problems at Lehman Brothers, at MCI WorldCom, at Enron, et cetera. And you can run down the list. It's not the regulators, it's not the sell side research guys. It's a lot of those short sellers that go out. And I'm not saying there aren't bad actors in it, just like there aren't bad actors, bad lawyers and bad, doctors, etc. But it's just, you have to remember, how are you incentivized and how much grief do you have to put up with? And that's, why I think people who are negative get a pretty bad rep, because in some ways it's like, I always say I'm a weatherman, right? I'm not creating the weather. I'm not creating where the Credit Suisse has to get, nailed, or First Republic. If I go out and I say, look, I don't like these companies, I'm a weatherman. I'm trying to predict the weather, and hopefully I'm doing it better than the next guy, and that's how I make money. I'm not making these stocks go up or down. Obviously, if it's a tiny stock, you might be able to do that. But for a big cap name, that's impossible. All you're doing is focusing people's attention on it. And then if they think you're right, then that gets things going. And quite honestly, my view is, if somebody gets a name wrong, that creates a great opportunity for me to go in and buy the name if I think that research is not accurate. So that's a kind of a long-winded way of answering your question, but yeah, it's very hard to be negative.
Well, I'd argue there's also two different types of negative, right? So one is being negative on macro, which everybody seems to want to be. Right? And then there's negative on an individual position, individual security, right? Which, to your point, requires much more due diligence. It's very easy to say, well, look at how much debt there is in the system. That means stocks have to go down. That doesn't tell me anything about when to sell or when to buy. Whereas if you're doing an individual stock that's based on fundamentals, presumably that's a much higher standard and takes a lot more purposeful effort than retweeting and liking things, which just sound bearish and sound convincing.
Yeah, but I would say getting the macro right is tough too, because there's sort of this reflexivity, if you want, associated with it. Because in the past, right, if the macro gets bad, then the Fed's going to step in at some point. Right, 2018 is a great example, as you may remember, Michael. The market, the S&P was down almost 20% in the fourth quarter. The Fed had been raising, then they turned around, stopped, and then started cutting again. And so the point being is that even the macro is hard to get, because trends can go on longer than you ever imagined humanly possible in terms of timing, and even some of the best calls, sometimes they'll take forever to pan out. So you can think about the irrational exuberance speech. I'll give you a great example, right? Alan Greenspan, former chairman of the Federal Reserve, considered rightly or wrongly as one of the best out there. He gave a speech on how stock prices were irrationally exuberant. Do you remember when the year it was that he gave that speech?
Yeah.
It was
1996.
Exactly.
Yeah, 1996, right?
Yeah.
I always, it's so funny you say this. So there's so much in what you're saying that I myself, in my own communication, say, like even the idea of weatherman conditions. Greenspan was right, but he was right. He was early by 4 years. Which in the context of markets is actually nothing. That's actually transitory.
Right? Well, but yeah, I mean,
people don't think of those terms.
Well, exactly. And I kind of look at it and I go, look, I always say if you're early, you're wrong. Because in my job, the goal is to make money, right? You could have shorted GameStop. If you shorted at $10, you had a lot of pain to 450, right? And you were wrong. I mean, but on the long term, you might be right. And so that's the hard thing about being negative as well, is you got to get the timing so well. Because I still remember in 2000, right? So Greenspan gives a speech in 1996. And this happens to a lot of people, where the market's working against you for so long that people may forget this. But in 2000, Greenspan kind of changed his tune. He said, well, I think this is a new aged economy, and we may be at a permanently higher level of productivity, et cetera. And that turned out to be the peak, right? So he actually got that flip-flopped, where if you give him the productivity speech in 96, market ran up, it went up a ton in those 4 years, and then said, well, you know what, I think we're at a rational exuberance phase. That would have been brilliant. In fact, he did in the exact reverse. And this is a person that probably has access to more data than anybody on the planet, with the exception of, maybe Jamie Dimon at JP Morgan. So that tells you how hard it is, even on the macro, to get it right. And we could even talk about the widowmaker trade in Japan, shorting Japanese bonds. But yeah, some of these things can take a long time to play out. So I think the macro is pretty tough, quite honestly, as well, because the markets are sort of biased by governments, officials who want to get reelected, right? If you in a recession, it's very hard to get reelected. And, quite honestly, Federal Reserve chairman, they don't want to be viewed as the villain. I mean, think about how much hatred Jerome Powell's getting. I mean, even Volcker, people forget, he cut rates. And then he was forced to raise them again because he had cut and then inflation took off. He didn't want to be the villain either. He just kind of had to do it in the 1980s. And that's also something to keep in mind, is that people are biased by human nature to want to be bullish. And so you need to take that with a grain of salt. That's why the moves down can be so violent and vicious when they do happen.
Which, by the way, is why, just even go back to the earlier point of the focus around your fund, around risk-adjusted returns, it is easy to say but hard in practice, because, risk-adjusted assumes it's a normal distribution, assumes there are not fat left tails.
Mm-hmm.
I keep going back to last year. Bonds, the aggregate bond index, the Sharpe ratio on the aggregate bond AAA index was worse than the Sharpe ratio for equities in 2008.
Yeah.
Right. I mean, so it was on a risk adjusted basis, last year was worse than 2008, but just for bonds, not for stocks.
Yeah. And I think if you think something is safe, I mean, think about how Silicon Valley Bank got into trouble. They own treasuries, the safest thing on the planet, and they got absolutely carried out by it. And that's the issue, I think. And we have some slides on danniles.com on this, but slide 26 on that kind of shows our drawdowns during horrible periods of time. And I can't get too specific, given government regulations, but we made money last year in the hedge fund. The market obviously didn't. It was down, 19%, the S&P 500. But the reason is those shorts really gave us returns, and our view coming into last year was that the market, the S&P 500, would be down at least 20%, if not more, and that was going to be driven by high inflation and interest rates going up. So obviously in that environment, you're getting killed on your bonds, you're getting killed on your stocks, and what's more scary about that situation is where you're getting killed pretty hard, to your point, is on your bond portfolio and some of the safest things on the planet, because treasury yields are just getting absolutely smoked. And that's not something, that's not something people have been used to really for the last 40 years. And if you go to slide 14 that I have, it kind of shows treasury yields, US, German, Japan, China, for, going back to the 1960s. And what you can see is pretty much for 40 years straight, you've made money owning bonds. And so last year was a real shock, to your point, because if you've been making money for 40 years, and granted, right, it moves up and down a little bit every year, you kind of go, oh, well, what could possibly go wrong? And then all of a sudden you find out, yeah, especially the last 13 years have been just propped up by easy money, et cetera, because you've had no inflation. And I think that's the key point, and I'm sure we'll talk about it later, but the key difference between this environment and the environment for the last 40 years is you've got high and potentially staying high inflation for the first time. And that changes how you have to invest relative to anything you were thinking over the last 40 years, and at least the last 13 years when you had the Fed and governments able to step in anytime the market went down and support bond prices as well as stock prices.
So last year around, I don't know, second quarter, admittedly I was early in saying this, I made it a point in media appearances to say that inflation shocks are deflationary. And I'd argue we may be starting to see some of that, because with inflation shocks come interest rate shocks. With interest rate shocks come collateral shocks, which is ultimately what's morphing into this, financial crisis you can argue we're having now. But I want to go on that point you mentioned a little bit earlier about there's a bias, right, by the Fed, by the government, by elected officials. I keep making this point. We're in a pre-election year. Pre-election years historically are the strongest of the presidential cycle. A lot of that's because the existing party stimulates so that voters vote based on nominal, not based on real. And I put out a tweet that got quite a bit of engagement saying that, how do you stimulate in high inflation through a manufactured banking crisis? Now, that sounds a little conspiratorial, but I am curious to hear your thoughts on how much of this, in quotes, banking crisis really did come out of nowhere versus it's been building for a while. And in some ways, this gives the Fed somewhat of an out around QT.
So, yeah, a lot of good points you brought up. So, if you go back to an interview I gave last November, I talked about the fact that what really concerned me over the coming year was a big financial firm failing, like Long-Term Capital Management in 1998 or Lehman Brothers in 2008. So we've obviously got the start of that. But I think, so this has been building for a while. I mean, we entered this year with $620 billion, and you can find this, like you can go look at each bank balance sheet. $620 billion in unrealized losses against a capital base of these banks of $2.2 trillion. So it's like anything, like I think the title to this slide deck is, how did you go bankrupt? And it's two ways, gradually and then suddenly. That's an Ernest Hemingway from something he wrote. And that's really what happened. Like, I thought there would be something like this, but I figured it would in the back half of the year after the Fed raised a couple of more times. And so this has been building for a while, much like the financial crisis in homes had been building for a while. And then it all of a sudden hit. And I think the problem this time, which is why, and you're right, and these inflationary shocks ultimately end up being deflationary. But the thing you have to remember is there's like several big trends that are reversing that have been going on for decades that were deflationary that are now inflationary. The first one, which everyone knows or should know, is China. It used to be we would outsource manufacturing to all the lowest cost regions in the world, and that was primarily China. Now, because of geopolitical concerns, we are manufacturing semiconductor chips in Arizona and as opposed to in Taiwan. But those chips are costing you twice as much. So that's the first problem, is inshoring or friendshoring versus, outsourcing. The second one is you've had this issue where even emerging markets, you've got birth rates going down. So if you think about it, in a manufacturing country, the more people you have, those are people that can produce goods. That takes down the price of all your goods. China had a declining population last year for the first time in decades. And the thought is that's actually going to continue. And you're seeing, and this is a normal occurrence, right? As countries get richer, the birth rates start declining. And so that's a second big inflationary shock you've got, which has been deflationary.
And not to interrupt, but I think the argument that you're making there, correct me wrong, is that is enough to counter the deflationary argument around an aging demographic.
Well, exactly. But what I'm also saying is that it changes how you should be thinking about things from a longer term perspective versus all this day-to-day noise we get, because you get data every day, right? And what I'm trying to focus on is bigger picture. Is inflation a tailwind or a headwind? And for the last, several decades, you've had sort of deflationary forces helping to push up the price of bonds and push up the price of stocks. That's changing right now. And the final piece of this is green policies are great for the environment. And I'm a big believer in those. The problem is they're also very expensive relative to dirty fuel like coal or oil. But remember, governments around the planet are pushing back against oil drilling, production, coal, whatever, you name it, which is great for the environment. The bad thing is that's also inflationary in nature. So those are three big trends you have kind of working against those deflationary shocks that you are, or the deflationary shock that typically follows inflation. And the final piece of this is it's slide 7 on my deck. And this is what got me really negative on markets well over a year ago at this point, is you've got twice as many job openings in the US as people unemployed. If you look inside inflation or core PCE, which is the Fed's favorite measure of inflation, 55% of that is services excluding housing. 55%. If you've got twice as many job openings as people unemployed, you're going to need a pretty big slowdown to make services inflation go down. That's wages, basically, right? And if you've got a lot more jobs out there than people to fill them, wages are going to stay high. And we can get into reasons why, but we are where we are right now. People have retired early, less immigration, etc. Bottom line, there's just less bodies to fill the jobs we have, which is the other reason why I see inflation being high. And by the way, that gap between people unemployed and job openings is the largest we've ever seen as far back as we've got data.
How does that interact with the round trip in savings? Right, because I'm going to assume that as savings basically dwindle down to nearly nothing, there's going to be more incentive for people to get more jobs.
Well, and that's a fantastic point, and absolutely true in the sense that if you look at it, and we've got a slide that kind of covers this, it's slide 15 and shows the savings rate. And the savings rate during the pandemic went up to over 25%. But because of high inflation, that number's gone from 25% all the way to almost historic lows over the last 70 years. And consumers had saved $2.5 trillion in excess savings at the peak of the pandemic. And that was sort of Q3 of 21. That number has now gone from $2.5 trillion to $1.5 trillion because they've had to burn through that. And by the end of the year, they're going to be through most of that. And that's one of the reasons we really worry about how the holiday quarter coming up this year is going to look, because consumers are going to be through that. And then you can get into, SNAP benefits, which is, food stamps type stuff, right? That's ending. The moratorium on student loan forgiveness, or not having to pay them back, I should say, that's ending as well. And so there's going to be a lot of things that go on that's going to deplete that savings rate even more. That's going to put more pressure on good sales in particular. And the stock market is very geared towards good sales. And what I mean is, the company that produces your smartphone and your PC, et cetera, that's listed on the stock market. Your barber, your pizza shop, your surf instructor, your tour guide, those guys are not listed on the stock market. So the stock market is comprised of a much larger percentage of goods producing companies like, Apple and Dell, et cetera, versus the other type. And during the pandemic, we had nothing to do but spend money on cell phones and PCs, et cetera. And now that, that's pretty much done, and especially in China, and don't forget, China is the biggest consumer of commodities on the planet. Now that they're trying to re-stimulate their economy, that's going to drive inflation as well. But the spending is probably, again, going to be probably more services based because they've been stuck for 3 years versus us at 2 years. And now they want to get out and do things. So there's a lot of cross currents going on at the same time, but China opening up is going to be inflationary as well. And so that's why I'm not in the same camp of, wow, the Fed, if you look at the futures markets, obviously they have priced in that the Fed's going to cut rate 4 times this year. I don't think they're going to be able to do it because inflation is going to stay high. And as much as everybody on this podcast is listening because they probably all own stocks, the problem is a good 40% of the population doesn't own stocks, and 30% don't own homes, and so they're the ones who are really getting killed by this high inflationary environment, and they're voters too. And that's why the Fed has to really go and deal with it. And more importantly, they're the people that can least afford to deal with high inflation, right? Because they don't own stocks, they don't own homes that benefit from an inflationary environment. They're just getting killed every time they go to the gas pump or they go to the grocery store or have to pay their rent.
Just for the remaining minutes here, everybody please make sure you follow Dan Niles on Twitter. This will be on all your favorite platforms under that Lead Lag Live banner. And as always, my name is Michael Guyad. In talking about China, it's interesting. It takes me back to a Twitter space I did with Louis Vincent Gov of GovCal. And he was very adamant in this idea that you're not going to have a recession in the U.S. because China is going to be the driver for global growth. It sounds like for you, it's less about global growth, more about global inflation as China drives it. But do you think there's some validity to that idea that China is going to be the thing that pulls us out of sort of a deep type of decline economically?
I'd like to believe that was the case, but the problem is that that's not showing up in the data. So if you look at the data coming out of China, and I've talked to a lot of companies that do business in China, and demand has not picked up the way they all had hoped when China came out of zero COVID in December of last year. Now, granted, you had a surge in COVID cases in January, but February and March so far, demand has not picked up the way people had wanted. Now, and part of this is because China's consumers have got about $1 trillion or so, a little over $1 trillion in excess savings. But in Asia, the thing that people forget is that there's not the social safety nets you have in more of the developed countries, especially the US. And so Asians tend to be big savers because they're not going to count on a quote unquote social security to save them when they get older. And so they tend to be big savers, and you're not seeing the spending coming out of China that people thought there was going to be. So I'm actually worried that this is going to be actually a tougher recession than I originally thought when I started the year, because I've been predicting a recession this year the whole time. And the market's going to have some issues under that scenario. And obviously the fact that you've had what's happened at the banks, that's tightening lending standards. So that's like the Fed hiking rates by another 100 basis points, at least. And with what's going on in China, which to your point, I think is a very accurate one, I thought that would be very helpful as we're figuring out it's actually potentially going to be a problem if they're not spending and their consumers are saving, because they're seeing all the same stuff we are and going, wow, this could be a lot tougher than I thought. Maybe I want to save a little bit more of that money I got instead of spending it. Sure. And thanks for your kind words. Appreciate it. I think there's only 2 things that determine stock prices. It's your earnings and then the multiple on those earnings. And the multiple is easy. You can kind of look and see where that is. And for the S&P, it's a trailing multiple of 18 times. And so back to what I said earlier, our fund looks to make good risk-adjusted returns. And the 2 components of that, so your EPS and your multiple. So 18 times, how do you put that in perspective? I mean, we've got some charts that go back over time, if you go to our website, and shows that if CPI is over 3%, the trailing multiple is typically 15 times over 70 years worth of data. It's trading at 18 times. So that tells you there's 20% downside just from multiple potentially compressing, if that's what it does. And I'm a big believer in math, right? I go, well, what's the risk I'm taking? Well, that's definitely a risk. The second risk is obviously EPS estimates are too high. they've been coming down since, first they were going up for 2 years straight since COVID. They peaked out in June of last year at about $252 EPS for the S&P 500 in 2023, so this year. That number has now gone from 252 to 220. And after what's happened over the last few weeks, that number I thought would go to 200, which is, by the way, that's pretty typical during a normal recession, is that your estimates go down about 20%. And so if you think this is normal, so I'm not being aggressive here in any of my assumptions, and that number should go to about 200. So if you say $200 in EPS, 15 multiple, that gets you to 3,000 on the S&P. Obviously, the S&P is closer to 4,000. So from a risk reward basis, I really do not like the market here. Obviously, I have some longs that I like. I have some shorts that I like. That's how we made money last year. It wasn't because our longs did great, right? It was because our shorts did very well. But that's how I don't like the risk reward at these levels for the overall market, even though there might be some individual names that I like.
By the way, Dan, I'm going to assume that on that 20% metric that's nominal, not real. Because conceivably, everyone falls for money illusion, right? If inflation were to keep on staying elevated for a while, but the market stays flat, you still get to the same place on a real adjusted basis.
Yeah, you can look at the 1970s, and we've got a chart on this, and you can kind of see, people look at their stocks, and what you can see is you basically had a lost decade. The S&P in the 1970s, it only gained 17% without dividends. Your dividends got you to 77, and that's despite earnings being up 138% because the multiple just compressed. So, and over short periods of time, obviously what's driving the market is the multiple. And that's obviously related to what people think EPS is going to be out in some future, point in time. But that multiple change is really what's pushing things. And that's why, for me, we're going to get a sense on earnings when these companies all report and guide, starting in about 2 weeks, when the banks start to report earnings. And that's when things could really get ugly, because every bank has got this same issue where savers like you and me are going, why am I getting paid 35 basis points on my savings account when I can go buy a 3-month treasury bill, which is the safest instrument on the planet with no duration risk, at 4.7%? And so all these bank earnings are under massive trouble. And that's why, we were fortunate to have a basket of shorts in a bunch of the banks that went under, including some of the banks that went under. So we had like over 50 names in that basket going into the bankruptcy of Silicon Valley Bank and et cetera, Signature Bank, and the issues with Credit Suisse. So that earnings piece of it, you're going to get a really good taste of it coming up here very soon. And don't forget, the financial services sector is the second biggest spender behind the tech companies themselves on IT spending. So they're the guys that go in and buy all this tech stuff. The banks are now focused on survival. They're not focused on spending a ton of money. They're going to be focused on efficiency and getting their costs down. And so this could be a very ugly earnings season. And the way to kind of think about it is, and we've got a slide that shows this, and I was kind of surprised. I rembered it, but I was surprised to see the damage done during Q1's earnings season in 2009, because when TARP was passed, so the Troubled Asset Relief Program, so $700 billion to protect all the banks after Lehman and Washington Mutual failed. This is slide 24 on that deck. The S&P rallied 24% from November 20th of 08 to January 6th of 09. And then it got absolutely crushed by 28% starting on January 6th of 09, when these companies started to report earnings through March of 09. And that's the part that concerns me. Is right now we're all focused on the banks, but pretty soon the impact of bank lending standards going up is going to affect the rest of the economy when these companies have to report and guide. And so that's what I'm sort of paying attention to, is the earnings side of the equation now, which will take center stage in a couple of weeks.
You just confirm my own thesis, and I approach the analysis different, but from an intermarket perspective, and alluding to the idea that April is not going to be a high volatility, only it'll probably be more directional, meaning a correction could be in April. That just confirmed one of the reasons. So I'm glad you articulated that.
I think the thing you have to remember is the markets always do this. And that's what makes it tough, right? It's a tough job. And you're completely right. But I think what's easy to forget is if you go back and you look at history, this is pretty typical. I mean, even, this is ancient history, but I'll bring it back forward. But to your point, if you go back and look at the Great Depression, you had 8 rallies in the S&P 500 of 24% on average. So 8 times 24% on your way to losing 86% of your money. So if you say, well, that's ancient history, and you fast forward it, during the global financial crisis and the tech bubble, you had, I think it was 5 rallies between 18 to 21% each in the S&P 500 on your way to losing 47 to 57% of your money. So every bear market, and I went back and analyzed every bear market going back to the Great Depression, you see these huge rallies in between, and the market sort of ignores it because I think throughout history, you sort of assume that the federal government or the Fed is going to bail you out. And remember, as I said, the last 40 years, that's what's happened every time because inflation has been declining. And I think that, to your point, is what the market's not really focused on. I mean, as I said earlier, the market's thinking the Fed's going to cut rates by 100 basis points in the back half of the year. And what I would argue is if the Fed has to cut rates by 100 basis points in the back half of the year, this is going to be a much worse recession than we ever imagined, in which case the earnings portion of the earnings times multiple is going to be way worse and the market's going to get hit. So that's why, we've started to actually add back in our shorts. If you go back and you look at our Twitter posts, we said, we think the markets, and this was back on March 10th, I believe. I said, we're covering most of our shorts. We think the market's going to rally, and obviously that's what's happened because we have a lot of things in place. We have some quantitative models, computer-driven models that tell us when a good time is to cover, go long. But even most recently, right, you had a rally from last, June to August, I think, where the S&P went up, 17, 18%. And then it went to new all-time, went to new lows at that point, right? So I think this is pretty normal. And I know it doesn't make a lot of sense, but this actually makes a lot of sense when you look at it in the context of history. The market's sort of ignoring things until it doesn't.
Yeah, it kind of goes back to that line I keep saying: bear markets make fools of bulls and bears. Right?
Yeah,
I think that's unequivocally true because that's what you're talking about, right? You end up having these melt ups and then crashes, melt ups and then crashes.
Yep.
I mean, this the nature of these kind of environments.
Yeah, and every time it goes up, it sucks people in. I remember how many people were on TV last October or so saying, oh, the market's never retraced 50% of its prior decline and gone on to make new lows. And, it's, this technical indicator and that technical indicator. And then the market breaks and it goes to new lows by, October or so. So I think the key is, this is a different environment, as I said earlier, than anything we've dealt with in the last 40 years. And that's why you kind of have to take the playbook and throw it out the window that you've been using. And I just look at it on a risk-adjusted basis, as I said. And one of the first things I look at is, well, what's the multiple I'm paying relative to the market? And if that's high, and I think the earnings risk is high, then even if it's a quote-unquote great company, I'm just going to want to stay away from it. Yeah, no, it's a great question. I think I had this quote in my investment letter coming into this year, and it was, I'm going to paraphrase here for brevity, but, Charles Darwin said it's not the strongest or smartest of the species that survives. It's the one most adaptable to change. And so to your point, is it rates or earnings? We're going to find out real quick because in 2 weeks, as I said, we're going to have earnings. And quite honestly, we're entering the pre-announcement period, right? It's almost the end of the Q1 period. And so we're going to see some companies come out and cut their numbers. And then we'll see how the market reacts. And so we're going to get that first taste of it. And so is this like the March quarter of 2009 when the S&P went down 28% after a rally 24% in 6 weeks? We're going to get a taste of it. And I think you're going to have to, be very adaptable on your thinking. But I think the one thing we do know for sure is that earnings are going to be coming down for the rest of the year because you've got this massive, you can think of it that the Fed raised by 125 basis points, right? And I think the thing that people are willfully ignoring is the ECB, European Central Bank, raised by 50 basis points, despite being in the process of trying to save Credit Suisse. The U.S. raised by 25 basis points despite being in the process of figuring out how to save, First Republic. And so I think the rates piece of it, the multiple for the market is pretty high given where rates are and what you can get for a risk-free return of nearly 5% on a 3-month T-bill. And so I think we're going to figure out what matters. I mean, for me, I use a lot of technical. I've got like 20 different, quant metrics that my computer takes a look at to try to figure out, well, when is this short covering rally running out of steam? And that's why if you follow me or you go back and you look at my tweets at Daniel T. Niles, which is my Twitter handle, you'll see that off and on, I'll say, you know what, I think the market's going to rally, just like I said on March 10th. And, the S&P was obviously lower then, and we're dealing with all these bankruptcies. But I think right now, I think earnings are going to matter. But we'll find out, right? Maybe I'm wrong and people go, oh, well, the Fed's going to cut by 100 basis points and the market can go up some more. But at this 4,000 level on the S&P, I think we're sort of running out of gas. But the good news is we're going to have a really good litmus test very shortly.
There's that great line, right? It's nothing matters until it matters. And then when it matters, it's the only thing that matters, right? I mean, that's the nature of markets. And maybe this time it is going to matter, to your point.
Yeah, I mean, and people didn't care about bank balance sheets right up until 2 weeks ago. And then all of a sudden they cared because it's like, oh, well, these banks all have treasuries. What could possibly go wrong?
And anyway. That's why analysts downgraded them. Exactly. Go back to the early part of the conversation.
Yeah, I mean, I'm going to go through this quickly. I think each company, the story is so different. So Apple has had this wonderful multiple expansion, but it's trading at 26 times. And so the market's at 18. And don't forget, China's a big end market for them. And as I said earlier, the Chinese aren't buying as much stuff as I thought they would coming out of lockdown. And so at a 26 multiple, I'm just not interested in that. Microsoft is more tricky because it's trading at a 28 multiple. So it's way more, expensive than the market at 18 times. But at least there, I believe the PC industry might have actually hit a bottom. Unit growth was down close to 30% in the fourth quarter. I think that is the worst. And don't forget, it was up a lot during the pandemic because we're all at home and we're buying PCs to make sure we can work remotely, and our kids are at home like mine were, and we're buying them PCs to attend college virtually, etc. So that one's a little bit more tricky. And obviously they have a pretty good presence in AI, which is good for their multiple. So that one I'm a little bit more mixed on. Amazon, obviously the multiple has never made sense, but it's at 37 times. The issue here is that, I don't know about you, but for me, I mean, I'm enjoying going out to restaurants and going to a supermarket, if nothing else, and getting out, right? And so people want to get out, they want to do stuff. And with Amazon, because the multiple is as high as it is, that gives me some pause. The bigger problem I have is that they don't make money on their retail business. I think everybody kind of knows that. They make money off of Amazon Web Services. And what do web services do? They host other companies. A lot of those are money-losing startups that have now just gotten absolutely crushed with their funding cut off from venture capital investing before, which led to the problem at one of their biggest lenders, which is Silicon Valley Bank. And lending standards have now all gone up. So they're going to need less hosting on Amazon Web Services, which is why you saw another round of layoffs coming. And so with Amazon, I really love the company. I mean, I get packages coming every day from those guys, but that's not where they make their money. And that's the problem. It's the web services piece. And there's going to be a dramatic step down in usage from the companies that need web services because they're too small to do it themselves. And so that's why I've got an issue with Amazon. With Google, that I'm not worried about market share loss to Microsoft or somebody else from generative AI and ChatGPT. I think Google's going to be fine. They've got more data than anyone on the planet because we all search using Google. So, and that's another discussion. But so I'm not concerned about that. What I am concerned about is the fact that they're now going to have to return search using some of this generative AI. And as the chairman of Google said, that's 10 times more expensive. And obviously that cost will come down, but that's going to put pressure on their margins going forward. The good news with Google is it's at 18 times, so is the market. And so that's a little bit more mixed. But remember, their business is off of ad revenues. And during a recession, ad revenues, that's one of the things you can control, right? You can't control how many customers buy your product. You can't control how much advertising you have. And so that's somewhat problematic, but from a multiple basis, it's one of the better ones. Facebook, that was one of my top 5 picks entering this year. You can see I posted that early in the year. Obviously, the stock's done really well. It's at a 21 multiple. It's not that high, but it is higher than the market at 18 times. The good news for them is that they have the most cost that they could cut out of anybody. That's what they did. That's why the stock's up so much. They're going to see this stuff. I never thought in a million years that TikTok would be banned because you've got 150 million users in the US. But you know what? Maybe I'm wrong. And maybe the politicians, because a lot of those 150 million users aren't voters, will actually do the right thing and ban it, in my opinion. And that would be huge for obviously Facebook, because their Instagram product called Reels that competes with TikTok was doing well before this. If that happens, that'll be really great for them. And their AI driven advertising, which got murdered when Apple, started up their privacy stuff earlier and cost them, by their own admission, 10 billion in revenues, that should actually really help. And it seems like a lot of businesses are going to them to advertise. So that's probably my favorite of the bunch. So anyway, but the point being is each one's different. As you can tell, I spend time going through each one and looking at the multiple and what do I think for earnings. Facebook's probably the only one out of the names I mentioned where I think numbers actually probably go up when they report versus going down, which I think will probably be the case for everyone else.
By the way, I'm going to argue real quick that banning TikTok would also fill all those job openings that you mentioned a little bit earlier. People are going to need to find work if they're no longer influencers.
Well, they'll probably end up on, I hate to say this, but I think they'll probably end up on a different platform plying their trade. So it's a reason to like Facebook, but you're right. I think the big thing would be, honestly, and this just comes down to your political beliefs, I guess. But, I'm an immigrant. I came here. It was the, 5 people with 1 bathroom, 1 bedroom story growing up. And, my parents were always like, look, you got to work hard. The world's never going to give you stuff. You got to go take it. And so I think if you kind of incentivize people to go back to work, that would fix a lot of your problem, because to your point, the participation rate in terms of number of people of working age that are actually looking for jobs is pretty low. And so but if you're sitting at home and you can get a check for doing nothing and you're able to work, that's that I don't think that's correct, but we'll find out. I've never understood TikTok social media influencing, but you know what? Kim Kardashian is a billionaire for a reason, right?
I definitely do not have Kim Kardashian's skill set. That's for sure. Okay, hold on. So I made it for the last few minutes again. Everybody, please make sure you follow Dan Niles here on Twitter. Just from a portfolio management perspective with the hedge fund, I'm curious, how do you determine your net position, right? So I get it. Everyone talks about longs and shorts, but ultimately it's about how net long or how net short, right? It's going to be more of a driver of performance. So roughly, what was that kind of net positioning last year? And how do you even determine, how much to go long and how much to go short?
So yeah, nets are really, my number one thing is leverage kills. And so unlike a lot of hedge funds, I don't use a lot of leverage. So over 19 years, I think my gross is 125%. So in plain English, that means, let's say I have 100 million in assets, I'd have 125 million invested. But out of that 125 million invested, when you take the percentage I'm long, that's something like 70 something percent, and the percent I'm long is something like 50 something percent. And so you end up with a net exposure over history of somewhere around 25%. You may go, well, okay, that sounds really stupid because the market always goes up. So why would you be 25% net long? And the reason is that we get about 80% of the return over time. You go, well, why the hell would I want 80% of the return? Well, you got to remember, my fund is more like insurance, and it does well when the market's terrible. So last year we made money. At the beginning of COVID, when the market was down 20%, we made money. Now, to your question of how do I determine the net, we've been 40% net short in the fund before. We've been 90% net long in the fund before. So how do I determine those two extremes? A lot of it is we've got about 20 or so technical metrics that we look at And then on top of it, obviously, it's all the fundamental research that I'm doing. And if those match up and I go, the fundamentals sound terrible and the stock market's sitting at technical levels where it looks like it's overbought, then I go ahead and I crank up my short positions. If it's the exact opposite, so March 10th, right? Like you got all these bank failures, but I'm looking at my technical metrics and they're going, you need to cover because this thing is oversold and it's going to rally. That's how we go ahead and decide we're going to take our shorts off. So typically what happens is our shorts move around the most in that if we're really negative, we crank up our shorts. If we're really positive in the sense that we're expecting a bear market rally, we'll be covering our shorts, which has this impact of raising our cash position, which, by the way, given where treasuries are, obviously cash is yielding nicely in the fund. And that's kind of how we manage it. And so for right now, for example, we're sitting on, close to 30% of the fund or so is sitting in cash because we did cover a lot of our shorts because we were expecting a rally. And that went from having over 100% invested in the sense that we had over 50% of the fund was in short positions. That's moved down to about 15% of the fund or so roughly. And that changes every day, right? So that'll probably be different by the end of the day today, just full disclosure. But that has the impact of, we covered, 40% of our shorts from our peak where it was before the bank failings. But that raises our cash level, and which is, I think, a lot less risky than a lot of people where they will have a high short position, high long position. But if something goes wrong and for whatever reason you're in a short covering rally and they're covering their shorts and they're selling their longs, you can get squeezed on both sides. And that just makes it riskier. Obviously, your returns can be fantastic, if you get it right. But you also have, as I'm sure as you saw, you've had some hedge funds go out of business recently because of the interest rate volatility. And they thought they were in, unvolatile treasuries. Like that can't move a lot, right? But it does. And so that's kind of how we manage our net.
I think that's a good place to wrap this Twitter space up. Again, everybody, please make sure you follow Dan Niles. And thank you, everybody, for joining. Thank you, Dan. Appreciate it.